Hello, everyone. Welcome to the final bar. My guest today is David Auerbach from the Daily REIT Beat. He's going to talk to us about a couple of real estate plays in a sector, real estate, which is one of the top performing sectors year to date. Certainly worth your attention if you've not paid attention to it yet this year. Overall, the markets, I would say, in digestion mode. If the last couple days, last couple weeks were the big meal, today is sort of that time after where you're digesting the meal, sort of digesting the gains, determining what leg may be next. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the activity of the markets using the power of stock charts, using data visualization techniques to make sense of key indications like price, breadth, sentiment, trend, momentum, investor sentiment, and psychology, trying to get in the heads of all the other investors out there and make sense of what actions they are taking. Overall, the market's essentially choppy. Today was sort of a choppy, flat day with the S&P finishing sort of a rounding error below zero. So after a stretch with with decent performance, we sort of have the pause. We have the dramatic pause to see what may come next. And if we're looking for a direction, I don't know if we have it based on today, but you certainly have a sense of where things have been headed going through the course of the of trading in recent weeks. You've seen strength overall and improving breadth conditions. And when people ask me about what has changed to cause my words, my language to get a little less cautious and a little more optimistic, it's things like the breadth deterioration that has unwound and gone more net positive. It's things like the mid caps and small caps participating, many other things which we'll get to here in a little bit. Excited to talk to my guest, David Auerbach, here shortly. Also, going up through the remainder of the week, we have some great guests as well. Wednesday, September 1st, we have Bob Lang from Explosive Options. On Thursday, September 2nd, I'm excited to talk to my former colleague and Fidelity's sector strategist, Denise Chisholm, coming from Boston. Next week, we'll take Monday off for the Labor Day holiday and wish everyone well on the long holiday weekend. Coming up next Wednesday, Ryan Dietrich from LPL Financial coming back on the show. Let's continue on with today's market recap. As I mentioned, when I think about the, having the big meal today is sort of the after party, sort of the digestion phase. And we've talked about the market overall, broadly speaking, been in a digestion phase. You've had leadership rotation and all sorts of things. But I think recently the markets have netted out to a net positive. And you've seen that in recent weeks with an acceleration to the upside. So the last, sort of hour yesterday into today is a little more of a choppiness. See, we're here on the end of the month here in August, and we'll see how the month of September goes in. But overall, I would say net positive or over negative. In terms of today, the S&P just below zero, closing around 45.23. Mid caps and small caps, all sort of in that same ballpark. I would say no real clear leadership between the three of those, and the VIX is popping a little bit higher, currently around 1650. Other asset classes very quickly, 10-year yields increasing, so getting just back above 130 today, and the TLT, which we often use for bond price proxy, sort of the long bonds, the Treasury bond down about 0.2%, the dollar essentially flat using the UUP. Gold price is higher, but commodities overall a little more negative today, and the energy sector was the worst of the 11 S&P sectors. Today, quickly at cryptocurrencies, overall net positive, although there's quite a differentiation. You see some outperforming others for sure. For example, Ethereum in the last couple of days really outperforming Bitcoin. And, this feels like one of those markets that's certainly still very new, very young, but starting to evolve, starting to grow and starting to mature. And I think when you start to see differentiation between cryptocurrencies, which we've certainly seen at times, I think is important to watch. So a day like today really shows you that there are gains, some outpacing others. Let's look quickly at a chart of the S&P 500 here and just reorient ourselves with where things are headed. So this is what the markets have looked like for the last year. And again, I think the phrase to describe this market is onward and ever upward, I guess is the way I would describe it. You have every month the market making new all-time highs. You've had a series of pullbacks, but those pullbacks have continued to make higher lows. So a market making higher highs and higher lows by definition is in an uptrend. That's sort of the way to track this. As we've talked about recently, our market made new all-time highs already again this week and a new swing high yesterday. We pulled back a little bit today, but overall, I think clearly the trend is still positive. What would you be looking for when the trend is going higher? You don't really need an indicator to tell you that the trend is up. We sort of see that by definition. So my thought is always, when will I know that things are changing? When will I know that things are different? And three things that I've mentioned previously that I would remind you of. The three things that would tell you the uptrend is over. Number one, we stop making higher highs. We make a lower high, which has not really happened so far this year. For the most part, every new swing high has eclipsed the previous high, and that's the sign of a strong, robust bull market phase. When that stops happening, that tells you things are changing a little bit. When we break the most recent swing low, that would be important. I don't have a little red dotted line here, but I should add one around 43.60. That's the swing low from a couple weeks ago. I think remaining above there sort of keeps that pattern of higher highs and higher lows intact. We break that recent swing low, and that tells you that the picture is changing. The third one, which I think is in some ways unique to this current market, is the fact that the uptrend has been matched with the 50-day moving average continuing to slope higher. We've closed below the 50-day moving average, I think 3 or 4 times year to date, and every single one of those times, we've gone right back above it the next day. And so at some point, that pattern changes. And when I look for sort of the ultimate indication that the world is changing and that the markets are no longer in this bullish phase, I think actually violating the 50-day moving average and confirming that, getting some sort of follow through would be a key indication. So in some ways, everything I just told you is the most simple trading system ever, and it's basically just remain involved in the market until those three three boxes are checked. When they are, that tells you at the very least that things are structurally very, very different. You need to be reevaluating where things are at. But overall, I'm not struggling to find stocks that are breaking out. I'm actually not struggling to find encouraging breadth readings, which is very different than what we've seen historically, so far this year, with a lot of deterioration in things like small caps, in things like advancers decliners, and things like bullish percent indexes. And many of those are sort of neutral back to bullish at this point. Let's go back to some of the sector returns. David Auerbach, my guest, probably could not have scripted this any better, but real estate, the #1 sector out of the 11 today. We'll talk about some of the longer term trends with David in terms of the evolution of the real estate sector, but worth noting, REITs at the top of the list today, followed by communication services, and then both the consumer sectors, which finished above the zero line. Underperforming today, sort of a mix of some of the cyclical stuff, things like industrials, materials, really energy leading the way lower, but technology as well. So sort of a mixed bag here. It's not a clear offense over defense, over offense, and sort of my interpretation of things. It's more looking at the individual sectors and how they're starting to revolve a little bit. Let's finish off our market recap, just checking in on some of the breadth measures. I realize I'm talking about some of the breadth conditions, really haven't looked at the breadth charts in a couple days, so worth looking at it. So, most recently, when we looked at this on Friday's show, if I remember, we go through the entire Mindful Investor Live chart list. We focused on this chart a little bit, which is the advanced decline lines for the New York Stock Exchange, which is on the top here, the S&P 500, the mid-cap index, the small-cap index. And this is showing you the cumulative advanced decline lines for each of those 4 different buckets of stocks. And you can see by the very subjective color coding system that green means it's been in a consistent uptrend, and the S&P advanced decline line has remained very, very positive. Really, even during the September, October sort of time correction last year, you still had the advanced decline line making new highs in October. That's before the market broke out in November. So the S&P has basically told you that the bull market phase is under no concern. It's continuing to go higher with no pause. You've seen the divergences, though, that come out in June, right? And that's when all the other AD lines made new highs and then have been unable to do so, right? They still have not eclipsed their highs from early June. The mid-cap 80 line has been essentially flat. The NYSE and the small cap advanced decline lines have been trending downwards in that case. The reason why I turn these back to the amber sort of neutral colors, because they haven't undercut their swing lows. So again, I see an uptrend as higher highs and higher lows, a downtrend as lower lows and lower highs. A sideways trend, which is what we're seeing with these advanced decline lines, tells you it's basically neutral. And I think that's what these are doing. One of my guests last week, John Kosar, on Thursday, one of his Asbury 6 macro indicators talking about overall market conditions. One of them was the New York Stock Exchange common stock only, if I remember right, is the NYSE advanced decline line. And it just turned positive last week. And I see the argument with it getting above its 50-day moving average overall. If it was a binary call, it's bullish or bearish, I could see the argument of that turning it back bullish because it broke below its 50-day there in July. That was when conditions were a little more questionable breadth-wise, and now you see them rotating back to the upside. One final chart, just thinking about breadth, is looking at the new highs list. We've talked about during longer bull market phases, one of the signs of a strong bull market phase is you see an expansion in new highs. One of the concerning parts or potential exhaustion signals when the market's going higher, but you see a deterioration in new highs. And then again, that's what you saw in the middle of June. These are one of the reasons why I certainly felt a lot more cautious here in mid-June, because you saw the advanced decline lines no longer making new highs. You saw the new highs list starting to evaporate, and that was definitely changing the character. If you look at what's happened in the last couple of weeks, you're seeing an increasing number of new highs in the New York Stock Exchange, increasing number of new highs on the S&P. I think if you expect further upside in stocks, I'd certainly want to see the new highs list continue to increase through the course of this week and into next week. We need to take a quick commercial break. We'll be back with my guest, David Auerbach. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the market activity using the tools of technical analysis and behavioral finance. There's so many charts to review. We get through as many as we can. A couple quick announcements before we get to my guest, David Auerbach. First off, if you have questions for us, send them to the Final Bar mailbag. We would love to hear from you and hope to point you in the right direction. Anything about market structure, market history, technical indicators, particular tickers or ratios that you're looking at, we'd be happy to answer your questions. You can email us at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Just go to the Stock Charts channel, leave a comment below the video that you're watching. Also, go to StockChartsTV.com. You can use your email address, set up a free account, start watching all of our great content immediately from our website, also from your mobile devices. Just search for Stock Charts TV on demand. I want to welcome on today's guest, David Auerbach, joining us on the show again. David is the editor of the Daily REIT Beat. Always does such a great job of illuminating a sector that I think a lot of people are underappreciate or don't understand well enough. So, David, thanks for joining us today and shedding some light on the sector for us.
Dave, great to be back again. Thank you so much for having me. I really appreciate it.
It's always a pleasure. So when we talk about real estate, a lot of people don't realize how much the sector has actually done well. And I've mentioned this a number of times in recent weeks, just the long-term performance of the REIT space. We want to start with one particular ticker that I know is top of mind for you today, MNR. Start us here. What are you seeing?
Sure. So let's use Monmouth as a precursor to why real estate right now. Monmouth is a hybrid industrial REIT that is currently facing a bidding war between Equity Commonwealth, their ticker is EQC, and Barry Sternlicht's Starwood Capital. Today, Monmouth shareholders Monmouth shareholders had their shareholder vote and determined that Equity Commonwealth did not have enough support for the merger. So Monmouth walked away from the Equity Commonwealth deal. Equity Commonwealth walked away. It doesn't necessarily mean that Starwood is going to win the deal, but what it shows you is that industrial real estate is very hot right now. And because of the various tenants, including Amazon, FedEx, and UPS, when you've got these three guys as the primary tenant for many of the industrial REITs, it shows you why industrial real estate is very hot. From a broader market perspective, though, Dave, to answer your question, I kind of take a look at it. Why real estate? Why has it done so well? From where I sit, the 10-year Treasury, which is the proxy, the benchmark to the real estate REIT industry, is at around a 1.3%. NAREIT right now says the REIT dividend yield on average is around just under 4%. So right there, you're getting about 270 basis points to own direct REITs versus bonds. And then if you play preferreds, because there's a whole extra segment of the preferred market, you can add an extra 100 and 200 basis points of yield on top of that. So unless you're worried about the 10-year going from 130 to 250 anytime soon, we're right now, I mean, you have the chart up, you know it better than I do. I really feel like we're kind of stuck in this little range-bound area between, call it 110 to 140, 150-ish. Am I nailing the area right? And yeah. Because we're range-bound right now, why not real estate? And one more thing. I was chatting with a client who was frustrated about why we're not seeing more preferred issuances by the REITs. And my response was, why does a REIT need to issue a 4 and 5% preferred when based on the cost of the market of the capital right now, they can get 2 and 3%, 5, 10, 20-year debt. They don't need to issue preferreds. So I think that's why you're seeing real estate so strong. I know we have a couple of real estate ETFs that we were going to talk about, and I just wanted to address it because the real estate guys have been issuing real estate ETFs right and left. The newest issuance has been the, this is what you just pulled up as GSI Capital, the Active Alps REIT ETF. This debuted last year. It's got about $22 million. I mean, it's a very pretty chart that you got there. Look at that performance. And so with active real estate being in vogue right now, again, because of the return to the office, return to normal trade, the stuff that was kicked out last year is like movie theaters and hotels and malls. That's the stuff that's been rocking it right now because these guys are, just really improving better results. Look at hotel companies. They're reporting better results week by week by week, regardless of a COVID situation right now. Then you also have JRE up there, which was Janus. I wanted to highlight Janus's real estate ETF. It just came out a couple of months ago. It's got 11 million under management. But for any of the investors that are watching this presentation right now, what I want to try to convey is Janus Henderson is a household name. American Century is a household name. All of these mutual fund families are now issuing brotherly, sisterly ETF products to complement their existing mutual fund structure. So JRE was launched to complement Janus's real estate mutual fund. American Century has theirs. And what you're seeing is pretty much every investment advisor, not every, most, if they have a sleeve of mutual funds, are now starting to embrace the ETF wrapper. One last ETF, if we could touch on it real quick, is NetL. I believe I've mentioned this one on this presentation before. They are now over 100 million under management. Why fundamental income? Why NetL? Very simple. This is the way to play your Dunkin' Donuts, your Starbucks, all your quick service, your drugstores. If you think about what held up very well during the COVID pandemic, it was those types of properties. So we're always going to have our demand for our Starbucks morning cup of coffees, or now for us, our Dutch Brothers, or whatever it is. But because there's this huge demand for net lease properties, if you find yourself shopping at Starbucks and Dunkin' Donuts and go to Walgreens and you always see the lines, maybe check out this particular ETF because it's a very interesting way to play the REIT industry.
It's such a great, I appreciate so much how you described all that, David. And you hit on a key point, I think, we've both spent a good amount of time with institutional money managers, and I found working with institutions, they sort of understand the value of real estate in terms of diversification, in terms of the return profile, how that's different from what you get elsewhere. And I find for a lot of advisors, and particularly individual investors, don't really understand how to fit it in there. But when I'm looking at a chart like NETL, it's hard to see that as anything but a consistent uptrend at this point.
Right. And remember, it's a basket of underlying securities. So that means that the most underlying components are performing well. Dave, as we mentioned, all advisors, it doesn't matter what shop they work with, all advisors recommend that you have an allocation of real estate somewhere in the range of 5 to 15%. Plus, we're a few minutes older now than when we started this conversation, meaning as we get older, our investment thesis change, where we rely more on that income and dividend component that REITs are able to provide. So as the generational gap extends and people get older, their investments in real estate and REITs because of that dividend continues to go up as well.
It makes sense, David. Listen, thanks as always for joining us. Be well, stay safe down there. We'll talk to you again soon.
Send me some pizza. Good seeing you, Dave.
You too. It's David Auerbach. David's the editor of the Daily REIT, and I really appreciate it. It's great to talk to people that are focusing on particular markets, and David just really knows this space very, very well. And I appreciate his description of how to think about a real estate allocation. Certainly something to think about if you've not incorporated into your portfolio in terms of your way of thinking. Certainly with charts like this, whether or not you think of it as an explicit real estate allocation, let's focus some of our attention on charts that are going up and to the right, paying a dividend, a decent dividend. I don't see any time when that would seem like a bad idea. We need to continue on. Our next segment is the Final Bar mailbag, answering some of your questions that you've sent in. Thanks so much, as always, for emailing us your questions at thefinalbar@stockcharts.com. Here's question number one. Can you offer us how you can use a scan to find those stocks you like when you say in your public service announcement, somewhere there's a stock somewhere that's breaking to an all-time high? So number one, thanks so much for watching the show and listening. I do repeat that. It's often something I tweet out every day or two is the PSA, somewhere, sometime there's a stock breaking to new highs. So how do you do that? There are a number of ways to do that using the scanning engine. I tend to keep my scans super straightforward. I tend to keep them super basic. If you want a more complicated way or a more sophisticated way is maybe the way to describe that. My boss, the founder of StockCharts, Chip Anderson, has recorded some episodes of a show called Deep Dive with Chip Anderson, and he is actually focused on the scanning engine at times, but I keep it very straightforward. You can see I have screens called New Swing Highs ETF, New Swing Lows, and New Swing Lows ETF. These are super straightforward scans. I keep it very simple, which is basically taking the universe. So right now, I just look at stocks that are above a market cap of 10,000, that's 10,000 million, so 10 billion or higher. So I'm kind of looking in that mid to large cap and mega cap space. I'm saying I need it to be a stock. I don't want it in ETF. I want it on one of the major US exchanges. And this right here, line number 3, is the argument that basically gives you a new high. So I'm basically saying the daily close is greater than yesterday's daily max close for the last 65 days. You can copy that exactly. If you hit pause on the video, you can copy that into one of your scans, and you can change the numbers to whatever you want. You can change it to do weekly or daily or whatever. And I experiment with those things. And for me, the scans are just to give me a workable list of charts that I look at. I'm not a big fan of creating a scan that's so particular that I need to come up with the ideal circumstances. I just want a list of stocks that have a certain profile and then look at the charts. And this is a scan that I review a couple times a week. I do one for new swing highs and new swing lows. So when I talk about stocks making new 65-day highs or lows, that's what I'm using to do so. Thanks so much for that question. Question number 2. Excellent show. Love your analysis, David. Newish member and superb platform. Thank you for that. And thank you so much for your kind words. $ EPRT is in a good uptrend. I'd love to get your take. Absolutely. I've not looked at this yet, so let's give it a shot. EPRT. Here we go. All right, so this is a REIT. So thanks for asking that. I should have asked that while we had my guest on here, David Auerbach. So what's interesting about this particular chart, and I would tell you within the real estate sector, there is some diversity, right? So you have you have all sorts of different types of buildings and structures that are supported through REITs and through a REIT structure. You have tower stocks, you have all sorts of different things. So make sure you look through the different groups. And the industry summary page, by the way, can be a really good way of understanding the groups that comprise the real estate sector, because you can see which ones are working and which ones aren't. What I like about a chart like this is in a consistent uptrend. You have a chart making higher highs and higher lows. You have it above 2 upward sloping moving averages. Most important to me, if you looked at some of the charts that David Auerbach was showing, the relative strength is not nearly as strong as this particular one that you asked about. So overall, I like the relative trend as well. If there's any cause for concern on this chart, it's that it's recently overbought. And you can see it was overbought in April. You can see it was overbought in June. Both of those times, you had a brief pullback to around about the 50-day moving average before we continue that uptrend. So based on the strength of the chart, based on the relative performance, which is very strong, decent chart, nice dividend payer, which I think is overall very strong. When it's overbought like this, all that means is to potentially wait for a bit of a pullback, because there could be a short-term pullback, an opportunity to get in at an easier level. But overall, I think that's a strong chart with a strong price and relative profile. Great example, and thanks for asking. Next question, do the medium-term and short-term PPO indicators on your S&P market trend chart need to be below zero in order for you to consider it a confirmed reversal? You were talking about the market trend model, which we review usually on Friday, but definitely on Monday for sure. At least one of those we'll review it every week, definitely on Friday. And I think you're asking about these histograms here. Do they need to be above or below zero? So what you have to remember is and this as well. So the way that I tend to use the PPO is just to look at the difference between the two moving averages. So the long-term model is the difference between the 21 and 34-week exponential moving averages. Those are the blue and red lines on the chart above. So yes, it would need to cross the zero line to turn negative for me. The same thing with the short-term model. It's simply looking at where we are at versus the 5-week exponential moving average. So whether the histogram is positive or negative tells me whether the short-term model is positive or negative. The medium-term model, I'm simply using the regular weekly PPO, or the weekly MACD is very similar to that. And I'm looking at when these lines cross up and down through one another. So the histogram is simply telling you when these two are crossing, but I'm basically looking at the two crosses. And in general, when you're using PPO, you want a buy signal when it's below the zero line. That would be a good buy signal. A sell signal when it's above the zero line is a good sell signal. Sell signals below the zero line or buy signals above the zero line are less important. It's more about the the sort of mean reversion, those long-term uptrends that reverse downwards, the long-term downtrends that reverse higher. Those are sort of the key signals to pay attention to. Final question, then we have to wrap the segment. During last Friday's The Pitch, Grayson Rose used a relative strength above chart panel to compare BUG to the VTI, which is a broad market ETF. Would you mind sharing with me how he created that panel? I have no problem doing that, and I have actually their chart list still saved. So we go down here to The Pitch. I find Grayson Rose. Here is his first chart, which was AVLR. All of his charts had a similar sort of format. You're talking about this one at the top, which is very simple. You actually use an indicator called price-performance and use the syntax. $ symbol will bring in the symbol, $ industry or $ sector would bring in the appropriate sector or industry ETF or index for a particular stock. For an ETF, it's not going to work so well. And he just did VTI as the denominator on there. So it's price performance. You do $ symbol as the left side of the colon, and then the ticker. I use SPY. Grayson tends to use VTI. Similar read. It's giving you a broad benchmark relative performance. We need to wrap the show, folks, and go to the 3 and 3. 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the S&P with the new highs and lows. In a market recap, we were talking about the benefit of the signal that is apparent when you have an increasing number of new highs. A healthy bull market phase should have a steadily increasing number of new highs, because what that implies is not just that the index is making new highs, but that more and more stocks are actually making new 52-week highs as well. So overall, I would feel much more comfortable with a bull market phase if it sees an increasing number of new highs. We've seen that increase over the last couple of weeks. I would very much be looking over the next week or two to see if you continue to see increases in new highs on the S&P and on the NYSE. So far over the last week, we've started to see that. Chart number 2 is gold. We've had a lot of discussions over the last week about inflationary concerns. And if people are concerned about inflation, gold tends to be a way that is often expressed. We've seen a bit of a bullish rotation in the GLD. If you look at June, July, August, lower highs, lower lows, sort of a downtrend channel. That channel has been broken to the upside. So a couple days ago, actually the end of last week, we broke above that channel to the upside. We're now testing the 200-day moving average, which we've been below for the last couple months. I think getting above that moving average is key for me. This purple line, which is just below 172, that would take us above the July and August highs. I think that's a key level to get above. If you do that, that tells you that gold has rotated from a bit of a distribution phase to more of an accumulation phase. Could be something to pay attention to. One of my guests on the pitch last Friday, by the way, was pretty bullish on gold in the short term. That was discussed there. If you missed that, by the way, go to stockcharts.com/thepitch and you can watch that great episode. Finally, I always look at some of the indexes and see which ones are making new swing highs or new swing lows. It's actually came up on my screen today. $XTC, the telecommunications index. This has a mix of things. It's worth looking at that. It's not just the old school telecoms, but a bunch of different names. But you see a bit of a rotation back above the 50-day moving average. Stocks and indexes like this that had been lagging June into July, which are now starting to rotate back to the upside. something to watch. Folks, that is our show for today. Special thank you to David Auerbach joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.